In this week's video, we'll review the latest fundamental and technical data to help us answer the question, will virus spikes bring much lower lows in stocks? One of the main benefits of tracking data is you can continually track the data over time and look for incremental changes in the data that can help you make better decisions. For example, on June 12th, we covered hospitalization figures for California, Georgia, Texas, and Arizona. Since June 12th, the total for all of those states, total hospitalizations, have increased roughly 38%. That is concerning. And more importantly, we're dealing with human beings, and there are serious concerns in these states related to the virus. How does all of that impact the massive amounts of data that we've covered in recent weeks that help us keep an open mind about better than expected outcomes? We've talked about this concept in the past, and it's more important than ever now. As it relates to investing, the only opinion about the virus that matters is the market's opinion. All of this concerning data is a known at this point. These tweets are dated June 24th. In this segment of the video, some of the comments related to the VIX were recorded as of Thursday evening. There are also comments relative to Friday's close and for the full week ending Friday, June 26th. And when we do the comparison about the present day look of the VIX relative to the recent look of the VIX in the rearview mirror, think about these concepts. What is the VIX telling us about volatility expectations looking out 30 days today relative to a few weeks ago and or a few months ago? And this portion of the video is being recorded 2 days later on June 26th. Thus, the market has had some time to digest this concerning data, and it's been digesting it now really since mid-June. Now our job as it relates to the markets walking forward is to look for meaningful incremental changes to the data, which can help us stay on top of the net aggregate opinion regarding all subjects on all time frames, and that includes the virus. Thus far, based on this tweet and this tweet, we really haven't seen anything yet that's overly concerning. That could change at any time, but it hasn't changed yet. For example, as of Thursday's close, the VIX was actually down more than the S&P 500 this week. What does the VIX being down for the week 6.98% as of Thursday's close tell us about volatility expectations over the next 30 days? Before we talk about how the VIX closed on Friday, June 26th, let's look back a few weeks and or months and see what we can learn. Top portion of the chart is weekly VIX. Chart is dated Friday, February 28th. This is the S&P 500, the bottom of your screen. This is the week that the S&P 500, the markets, and many market participants started to really become concerned about the virus. The VIX moved from relatively low levels all the way up to 50 roughly intra-week. The end of the week, it was up 134%. It finished the week at 40.11, also relevant. This close and this number spoke to volatility expectations for the market looking out 30 days. This is the S&P 500 on February 28th. An elevated level like this, and this number here in the upper left-hand corner of your screen, told us the market was concerned about the next 30 days. That turned out to be pretty accurate. The S&P 500 lost an additional 24.26% between the close on February 28th and the low on March 23rd. If we fast forward to Friday, June 12th, this is kind of this second wave type scare or a continuation of the first wave scare related to the virus. Thus, this figure here and this figure here spoke to concerns about the virus walking forward. Instead of 135% gain and finishing around 40, When the market started to become concerned again about the virus, this week, as of June 12th, the VIX was up 47%, but it's still elevated, not as high as it was before. Notice here, the first scare, the VIX got all the way up to 85. That's relevant relative to this spike so far. The highest we got intra-week on the week of June 12th was roughly 45. That's quite a bit lower than 85, and this close here is discernibly lower than this close here, but it's noteworthy. This is still an elevated close, and it still speaks to concerns about volatility walking forward. VIX chart dated June 12th, S&P June 12th closed at 3041. Thus far, the additional loss in the market, 1.21% as of the close on Friday, June 26, with an emphasis on so far. So initial scare back in February, up 135%. This week we hit as high as 50, and before this scare was over, the VIX moved above 85. Compare that to this percentage gain as of June 12th, and the fact that we closed closer to 36, and instead of getting to all the way to 85, we got near 45. How does this figure here, and this level here, these levels here, this figure here, and this figure here, compare to the look of the VIX at the end of the week on Friday, June 26th? At the end of this week, this is the close, on Friday, June 26th, the VIX was actually down this week. That's probably the good news from a probability perspective. The bad news from a probability perspective is this is still a relatively elevated level around 35, telling us don't get fooled by this in isolation. This is a factor, a relevant factor, but this level is also a relevant factor. A VIX sitting around 35, 34-ish is still a market that's concerned about volatility over the next 30 days. But we can make an argument. The highest high this week was 37. That's quite a bit lower than 85 in here, and quite a bit lower than 45 in here. Every comment that we've made about the VIX speaks to its current level. That's all subject to change if the VIX moves in this direction. Given what we have today, it probably tells us the market is not expecting a lower low in stocks. It's probably expecting a correction and then a continuing rally. And that is absolutely positively subject to change. But we trade the chart in front of us. All of this tells us it's still reasonable to keep an open mind about better than expected outcomes walking forward. And it's still reasonable to keep an open mind about a normal, 100% normal and to be expected correction within the context of an existing uptrend. Not a prediction, simply speaking to a wide range of possible outcomes. While our personal interpretation of the virus and its possible impact on the markets and economy is really not all that important, understanding bullish and bearish scenarios can help us with execution. For example, how is it possible that the VIX is down this week and for the most part the S&P 500 has been able to hang in there? One possible explanation and or theory: the market now knows that trouble areas, for example, Italy, things were not going well on March 2nd. They're going much, much better today. The market also knows that New York had a very, very, very difficult and stressful period earlier this year, and things are now at least trending in the right direction. Therefore, it's possible that the market is looking at concerning data in Arizona, Florida, Texas, California, and Georgia, and saying it's possible, like Italy and like New York, it's possible that things over the next few weeks and months will improve in these states as well. That, of course, is to be determined. And none of this impacts how we're going to monitor the net aggregate opinion of all market participants. However, from an execution perspective, if we understand how the market could possibly be looking past that data, that helps us execute if the data in the market is better than expected. It's very, very easy to understand the other end of the spectrum. The other end of the spectrum is, what happens if we shut down the global economy again? Well, that's pretty simple. The markets will not do well at all. And none of this will be very relevant in the short run. Like everything else, we have to walk forward and observe the data day by day with a flexible, unbiased, and open mind. And we do that by evaluating the chart in front of us and evaluating the data set in front of us, which means we're making no assumptions, good, bad, or indifferent, about what's going to happen with the virus, and we're not making any assumptions, good, bad, or indifferent, how things will play out in the markets. Here's a tweet from April 8th. These concepts prove to be extremely helpful in terms of helping us switch from a bearish stance to a bullish stance. April 8th. If a new long-term bull market has started, collecting bearish data will not alter the market's path. If the bear market is to resume, collecting bullish data and/or charts will not change that. The objective of all of this, the objective of the market model, is to find the true message from the market rather than the message we want to hear. If we live and breathe these 3 bullet points, it's very, very easy to cast your ego aside and switch gears from bullish to bearish if that's what the data tells us to do, just as we were able to switch gears between March 23rd and April 6th. All 3 of these bullet points apply wholeheartedly to this topic and to this topic. We're money managers, and the sole objective, there's not even a close second, is to manage the money well. It has nothing to do with protecting egos or forecasting anything. Now let's switch gears and look at some additional 2020 charts to try to provide some insight as to how the market is coping with this new shift in virus-related data. Here's some data that we covered in the Friday, June 12th, 2020 video. If you think about it, if you were an eternal optimist and incredibly bullish, you really would never even calculate drawdowns. The sheer fact that we look at historical drawdowns basically says we know volatility and drawdowns are inevitable. At some point, some painful periods are coming, even within the context of the strongest trends. These are hypothetical drawdowns here related to this study, the signal that was nailed down on June 3rd relative to breakaway momentum. On June 12th, we basically said it wouldn't be shocking if the market backtracked to any of these levels. Where are we today? It's very, very easy to understand and acknowledge the concept of realistic expectations when things are going well. It's quite a bit different to acknowledge it on a week when the S&P 500 is down 2.42%. But the whole purpose of doing this on June 12th was to give us a reference point in the future. And right now, relative to the signal that was generated on June 3rd, this is not particularly alarming. And an easy comeback would be, but what about the virus? Well, every single one of these historical drawdowns is related to some type of troubling fundamental event. Markets don't fall 6, 7, 8% for no reason. There is always something concerning related to drawdowns. And we've already stated, we're not making any assumptions about the virus. 100% respecting the virus. And that's one of the reasons why we took some profits earlier this week and we made some allocation adjustments. We really haven't seen anything that throws any of this out the window. However, when the data deteriorates, we have to get back in line, which is what we did this week. The reason for doing that is, if the market exceeds expectations, and let's say hypothetically it goes on to make a lower low, staying in line with the data will pay dividends down the road. Volume by price weekly, basic takeaway. These areas offer potential support. These are the levels that we covered on Twitter earlier in the week. Mixed bag. Closed below 30.27, but not substantially below 30.27. Closed slightly below the 200-day moving average, and we have not taken out 29.65. Nothing earth-shattering about any of these levels. They're simply reference points. The fact that we took 2 out of 3 out does speak to increasing bearish probabilities, hence some of the adjustments that we made this week. Later in the video, we talk about a VIX study. Here's the drawdown chart as of Friday's close for reference purposes. Nothing particularly alarming on this chart relative to realistic expectations that we talked about weeks ago. S&P 500 Friday's close June 26, still above the 61.8, 50%, and 38.2% retracement levels. Again, simply reference points. We cover this chart in more detail later in the video. Just wanted to be able to show the close on June 26th. You could show dozens of charts like this. The message is a mixed bag. JNK relative to IEF has a potential breakdown look here, but we know we can get false breakdowns. But all things being equal, this is starting to lean in a concerning manner. If we look at JNK relative to TLT, not so concerning. You can make an argument that both of these charts could be in retest mode. That is to be determined. Very, very similar concepts here. Growth stocks versus treasuries. You can make an argument we're retesting the 61.8, and even if that's not the case, coming back into the retracements wouldn't be the end of the world. Right now, we basically closed on the 61.8% Friday, June 26th. As we said, kind of a mixed bag. Mid caps relative to the S&P 500 holding this breakout. We could show numerous that are holding the breakouts, and we could show numerous that have somewhat of a breakdown look or failed breakout look. It's a mixed bag. Here's another one, SPY versus TLT, stocks versus bonds. Mixed bag. This is a lower high. We're still above these levels here. We'll just have to see how this and all the other charts and data sets play out. Friday's session, this is IEF. Not really a mad dash volume-wise into bonds. IEF was up on Friday, huge drop in the S&P 500. It was up 0.2%, 0.27. Hasn't broken out yet. If it does break out, then that speaks to odds. We own IEF, so we're not rooting against it. Here's one of your mixed bag charts. This is an unresolved look here, but this is a higher low relative to this low. This is a higher high relative to this high. And on Friday, RSP, the equal weight, outperformed SPY. Some good on this chart, some bad. You can pause your video player. Think of this. This is what New York looks like today. The market could be saying, this is what Texas could look like in the future. This is what Florida could look like in the future. This is what California could look like in the future. And this is what Arizona could look like in the future. That doesn't mean that volatility will immediately stop. Even under that scenario, we could easily have volatility over the next few weeks or months. Realistic expectations. This tweet speaks to consumer habits. And this JP Morgan statement here speaks to the changes in the viral related data. Covered these trend charts back on June 3rd and said this was a constructive look. June 12th, the market was trading at 30.41 with still a constructive look relative to trends. And this is the look of the chart before the market rallied in the last hour on Thursday, June 25th. This is 2:42 p.m. The market was basically flat. There's really not a lot of damage on this chart, and it's very, very difficult to say that the look of this chart is straying from the look of the historical bullish cases so far. It's not a prediction about what this chart will look like next week or next month. We're just making comments about the chart in front of us. Here's a close-up view after the 80-point decline on June 24th. Price is still above all of the moving averages. How concerning is the current drawdown in the S&P 500? June 15th short takes. We covered the recent spike in the VIX. History told us that in these cases, good things happen in the stock market walking forward. And these lines represent the hypothetical maximum drawdowns relative to these historical cases. And thus far, we haven't seen anything alarming. To capture these returns in the historical cases, you had to be willing to withstand a drawdown similar to the drawdown levels shown on the screen. How does this help us? If the S&P 500 is down in this area here, it's more concerning. If we're down in this area here, it's even more concerning. All of this helps us assess probabilities and the relevance of this study. How about intermediate term momentum? This is June 25th, intraday, 1:28 p.m. The S&P is down 40 points. Kopic curve has moved from below zero back above zero. Speaks to probabilities, favorable probabilities. MACD, weekly, bullish cross, and we've recaptured the zero line. You may remember from past videos, when black MACD is below zero, it basically says from an odds perspective, we're in a downtrend. When it's above zero, we're in an uptrend. Currently, above zero. Continuing jobless claims. Recently, really bad. This week, less bad. Historically, markets bottom once the data starts to shift from really bad to less bad. That's not an opinion, that's based on historical fact. $RVX is the small cap VIX. You can make an argument that this big spike and the fact that we're now down below the blue box or have traded below the blue box, similar to this point here, similar to this point here, and this point here. All of the vertical lines are similar. In each case, this occurs after the low. This occurs after the flash crash, and this occurs after the low in 2011. In all three of these historical cases, good things happened in IWM, the small cap ETF, walking forward. You kind of think of semiconductors as shorting the S&P 500 as I'm very confident about future economic outcomes versus I'm very pessimistic about future economic outcomes. 13-week rate of change. Why 13 weeks? It's been roughly 13 weeks since the March 23rd low. Only 2 times dating back to 2006. It's all of the data that we have. Have we seen a move from the bottom line to the top line? First time, April of 2009, after the major low was in place. This point right here is similar to this point here. This point here is similar to this point here. As you can see, it does not happen at any other point in time on this chart. What does this look here? And what does this look here tell us about the net aggregate opinion of all market participants regarding all subjects on all time frames, including the virus? 100-week moving average. You make a stand, 1994, good things happen. You make a stand near it, 2011, good things happen. Make a stand near it, 2016, good things happen. 2020, similar look. Does 2020 look anything like the year 2000? Absolutely, positively no. Does it look anything like 2007? Absolutely, positively no. 2000, we couldn't even make it back to the blue moving average. 2007, we were soundly rejected at the blue moving average. We've been trading above it now for several weeks. This looks more like this, and this relative to this or this. Clients and long-term viewers know this is a secular trend look. Price above an upward sloping 200-week moving average. Recently, the S&P 500 closed below the 200-week moving average for 3 consecutive weeks, And now we're getting ready to nail down 12 consecutive weeks above the 200-week moving average. Therefore, we wondered, how many times has something similar happened in the last 40 years? When we did the research, it was not the answer we were expecting. Once, only one time. Have to go all the way back to 1982, at least 3 weeks below, and then at least 12 weeks above, telling us that November 12th, 1982 has something in common with Friday, June 26th, 2020. Therefore, looking at the 1982 case, it might be helpful to know, how did stocks perform following the last occurrence? So to answer that question, here's the S&P 500, at least 3 consecutive weekly closes below, and then at least 12 above. After that, good things happened for a long period of time. From a secular trend perspective, from that point, the S&P 500 tacked on an additional 995% between 1982 and 2000. Notice, for the most part, price stays above an upward sloping 200-week moving average. It's basically what we have in the present day. From the 12th consecutive weekly close in here, really good things happen looking out 1 month to 5 years. You may be thinking one occurrence over this long a period of time really doesn't tell us much, and that's a pretty obscure question that you asked. Have to keep in mind, when we asked the question, we didn't know what the answer was. Well, we agree with all of that, but from a weight of the evidence approach, we have a ton of evidence that we've presented in recent weeks that tie the present day to 1982, not just this obscure study. April 10th video, 1982, right here. Again from the April 10th video, 1982, right here. May 8th, we covered something that only happened 5 times in the last 70 years. There's 1982 again, similar to something that just happened in the present day. May 22nd, 1982 again. Path of market returns on May 22nd, still similar to 1982 on May 22nd. And as we covered on May 22nd, a lot of skepticism, 1982. A lot of skepticism, major low 2009. A lot of skepticism in 2020. Anything else that we've covered that ties the present day to 1982? Yes, the extremely broad value line geometric index, something that's happened only 3 times in the last 38 years, one of them 1982, covered it on June 5th. And when we asked this question this week, we had no idea the answer would be once, and we had no idea that it would be 1982. But it ties in nicely with what we covered back on June 5th, and it ties in nicely what we covered back on June 12th. Here's 1982 again. Something very, very similar just happened in 2020, and in these historical cases, really good things happened in the stock market over the next 5 years. 100% of the cases higher 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Anything else tying the present day that we've covered to 1982? Yes, June 12th, 1982, right here. Present day, similar move. You may also remember from a liquidity perspective, we tied the present day to the early 1980s. And another extremely rare move in a breadth indicator, 2020, similar in 1982. And on Friday, June 5th, we covered the rare 10-day breakaway momentum thrust. Right there in that table, 1982. This is the performance of the stock market walking forward from the date of the signal. This date is similar to June 3rd of 2020. Something that just happened in 2020 is similar to these cases here. How about from a drawdown perspective? Have we violated this study? Not yet. Historically, this is typically where the drawdowns came in. This is the drawdown that we have on June 24th after the S&P dropped almost 81 points. And our purpose here is absolutely positively not to say 2020 is similar to 1982. There are countless differences between 2020 and 1982, just as there are countless differences between every year in this table and 2020. The point is, there are several similarities between 1982 and the present day. And if you know your market history, when you have something that's similar to 1982, that's very, very favorable from a bullish odds perspective. Was 2009 the same as 1982? No. A lot of differences between the two. What mattered was the stock market rocketed higher after this signal, and the stock market rocketed higher after this signal. We just saw a similar signal in the present day. And rocketed higher is speaking to a long-term, multiple-year outlook, not the next 3 hours or next 3 days. We've already said we're not trying to compare the present day directly to any one of these years, especially 1982. But whenever 1982 comes up, valuations come up. Covered this chart in last week's video in detail. This is 1982 right here, and it speaks to valuations. You can find our video dated Friday, June 19th for more information. It's important to keep in mind, this is not just a bunch of lines on a graph. This look here relative to this look here in 1982, and everything shown on this chart relative to these major lows are helpful because of these major bullet points that we've covered in the past. It's all about human behavior. Anything else that's happened recently that helps us evaluate the net aggregate opinion of all market participants regarding all subjects on all time frames, including the virus? The answer is yes. Big move like this speaks to future economic expectations. And that's a big shift relative to economic expectations here. And that's reflected in this rate of change, 13-week rate of change. Going back to 2007, only one other time have we moved from the blue line on the bottom to here. And that speaks to a rare shift in economic expectations. A rare shift in economic expectations. 2008, 2009, we hit this point here, similar to this point here, and it happens after the major low in the S&P 500. The same concepts apply here to the bottoming process in 2015 and 2016. In that case, we don't come down here, but we do tag this line here. The concepts relative to the actions of human beings are similar in all three cases. And if we take this chart all the way back to 1996, that's all the data that we have. Only 4 previous times have we tagged this line here, 13-week rate of change, meaning in every single case, it's a big shift. Bearish economic expectations to bullish expectations. 1999, 2002, 2003, 08, 09, 15, 16, and the year 2020. Therefore, it might be helpful to know, how did stocks perform walking forward from the dates that are similar to this date here? Well, the answer helps us from numerous perspectives. Concept number 1, in 3 out of the 4 cases, there was a lot of volatility over the next 4 weeks. The only case that was still green, 2016. This helps us with realistic expectations about how markets operate in the real world. It would be great if the market went up every single day. We all know that's ridiculous. Something to try to remember next time the market goes down. But this study also helps us with a longer-term focus. All 4 cases, the market was higher 6 months later and a year later. And 2 years later, the worst outcome, down less than 6%. 2 years later, the average outcome, a gain of 26%. The median outcome, 33% higher. This table speaks to, hypothetically, walking forward from this date here. This table also helps us keep an open mind about another extremely important concept. Even if really good things happen walking forward, we should always understand that a migration strategy might be necessary at some point down the road. It could be in 3 years, or in this case, it could be in 3 days. Maximum flexibility 100% of the time. Also important, maximum drawdowns in each historical case. These drawdowns are calculated from the close S&P 500 close on June 19, 2020. Hypothetically, in order to capture these returns in the historical cases, you had to withstand drawdowns like this, including, hypothetically, a move all the way back to 2873. So far, we're in line with our historical expectations. Anything else that we can cover in the present day that ties 2020 back to 1982? Yes, we marked up this chart on Monday, June 22nd. That was 63 trading days from the major low. The 63 trading day rate of change right here. We've only seen something like this 3 previous times in the last 95 years. One of them, 1982. What can we learn from market performance in the historical cases? Even if really good things happen for a long period of time, it wouldn't even be remotely surprising if the market was volatile over the next 6 months. And this is a concept that we've been covering for several weeks now. And guess what? Volatility has picked up. Historically, not only is it not surprising, it's really to be expected. However, it's very, very easy to look at this table and say, well, we should just liquidate our portfolio. That could be extremely dangerous, and that's a form of forecasting. Because even with all of these concerning colors in this table, the average gain was positive 6 weeks out, 2 months out, 3 months out, and 6 months out. And in the 1982 and 2009 case, 6 months later, things looked really, really good. So when you watch these videos, you basically can take away what you want to take away. If you want to take away that this is a bearish signal, you can do that. For us, we're not making any assumptions about anything. We don't trade tables, we trade the chart in front of us, and we'll continue to do so. Having said all of that, something that just happened on June 22nd, 2020 also aligns with a common theme in recent weeks. Historically, if you were able to withstand 100% normal and to be expected volatility, the rewards were outstanding looking out 1, 2, 3, 4, and 5 years. The market was higher 100% of the time on all of these time frames. And we know there's no free lunch in the stock market. In order to capture these returns, the median 6-month drawdown, 7.06%. From the date of the signal, 7.06% would take us hypothetically to 2897 on the S&P 500. Historically, to capture all of this, the median drawdown you had to withstand is this line right here, right around 2900. How about global economic expectations? Chart dated June 22nd, 2020. It's a monthly chart. This is an international growth mutual fund. Only one previous time in the last 30 years have we seen a spike like this, and it was after the major low in 2009. Have a similar spike in the present day. You can move across. Didn't happen at any other time. Like everything else, doesn't predict the future. It simply speaks to the probability of good things happening relative to the probability of bad things happening. And as we know, the probability of bad things happening is never 0. Hence the need for maximum flexibility 100% of the time, no exceptions. On June 22nd, it had been 63 trading days since the major low. A move like this from the top line to the bottom line in diversified bonds relative to the S&P 500. So this is bonds versus stocks. In the ETF world, think AGG relative to SPY. Only two previous times in the last 30 years, both of them occurred after major lows in the S&P 500. 2003, the major low comes in 2002 in October. You get a retest in 2003, a successful retest. Good things happen. This point here is similar to this point here, which is after the major low in 2009. These are the only cases in the past 30 years. Leisure and entertainment stocks says a lot about future economic expectations. Only have data going back to 2005. Right here, after the major low in 2009, similar to the present day. Wall Street Journal headline, June 23rd, global economy shows signs of pulling out of slump. Really bad to less bad. A common theme for all of us, because we're human beings, is to look at a chart like this and say, it's improved, but it still looks horrible. Where else could we have said, the economic index is improving, but it still looks pretty depressed? Right here. It's improving, but it still looks pretty depressed. That's after the major low in the S&P 500 in 2009. Tweet dated June 25th. Durable goods activity bouncing back faster than expected. Previously really bad, now less bad. There's another recent chart, June of 2020. Ties the present day to 1982. Only two previous times going back 39 years. If you know your market history, outstanding long-term entry point, outstanding long-term entry point. This chart doesn't tell us anything about the next 3 hours, 3 days, or really even the next 3 weeks. June of 2020, daily chart, junk bonds versus treasuries. YJNK versus TLT, done for a reason. If you felt that the economy would never recover and the Fed would never raise rates again, would you rather own a higher yielding TLT or lower yielding IEF? Market history says market participants would prefer TLT. Only have data here going back to 2008, only one previous time have we moved from here to here, and that's in the present day. Didn't happen anywhere else in between. This point here is after the major low in the S&P 500 in 2009. Similar situations, small caps, June 23rd. Only 3 times going back to the year 2000 have we moved from here to here. This is one in 2003. Here's the second occurrence, and here's the third. In the 2 previous cases, small caps performed very well walking forward from that point. They performed very well walking forward from that point. This point and this point similar to this point. You can pause your video player, an interesting theory on earnings and the stock market. Tweet from earlier this week. Hedge funds and large speculators have taken their largest net positions against the S&P 500 since 2016. Chart shows large speculators' net short positions in the S&P 500 futures. Look like this. Last time it occurred, right down here. Right down here is February of 2016. What happened walking forward in the S&P 500? The answer is really good things happened for a long period of time. This speaks to fear. This speaks to fear. This low speaks to fear. Right near the 2016 election, stocks do really well walking forward from this box, and stocks do really well walking forward from this box. So we have rare bearish bets, very skeptical group of investors responding to the American Association of Individual Investors weekly poll. Not a lot of enthusiasm. And remember last week we covered investors are sitting on the biggest pile of cash ever. You may remember from the May 8th video, we basically said that we could look at the performance of high-yield bonds relative to treasuries, and that would tell us something relative to the market's risk appetite. For example, before the major low in the S&P 500, TLT in blue significantly outperformed high-yield bonds. On the other side of the major low in this window, just the opposite. High-yield bonds crushed TLT. Therefore, if we look at the performance of these two ETFs since the major low, does it look a lot more like this or this? The answer is it looks a lot like this, which is after the major low in the S&P 500. If we want to increase the probability of finding the true message from the market walking forward, one of the best ways to do that is to have a sincere respect for a wide range of outcomes, from wildly bullish to wildly bearish. From a bullish perspective, we have a truckload of evidence that has accrued in recent weeks that helps us keep an open mind about much better than expected outcomes looking out 1 to 5 years. And thus far, we don't have any hard evidence in hand that negates any of that data. Look at this chart here on Friday, June 26th. I haven't even made a lower low yet relative to this low here. And in these cases where really good things happened, had drawdowns all the way down to these levels here, down to 2,800 would not be shocking. There's no free lunch in the stock market, right here. And if you've been reading about the virus for several months now, as most of us have been doing on Wall Street, it is incredibly easy to have a sincere respect for much worse than expected outcomes walking forward. As it relates to investing, the only opinion about the virus that's relevant is the market's opinion. And the best way for us to discern the net aggregate opinion of all market participants regarding all subjects on all time frames is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.